This is the Equity Management Academy Mean Reversion Trading Weekly Podcast for October 25th, 2021. Gold is about to skyrocket. Summary. Technology has created a completely virtual economy. This transformation has brought about many changes in the system. It has transformed the monetary system with the creation of Bitcoin, a virtual currency in a new and unpredictable digital world. The underlying momentum supporting this surge in interest rates in a digital currency is the fact that our old physical currency, the US dollar, is collapsing against gold and other real assets. Fundamentals. This transformation has brought about many changes in the system. Technology has created a completely virtual economy. It has transformed the monetary system with the creation of Bitcoin, a virtual currency in a new and unpredictable digital world. Blockchain technology is the foundation for the creation of decentralized digital assets such as Bitcoin and other cryptocurrencies. The underlying momentum supporting this surge in interest in digital currency is the fact that our old physical fiat currency, the US dollar, is collapsing against gold and other real assets. This collapse was brought about by the pandemic in March 2020 when we transitioned to a digital economy. Gold shot up $600 and reached more than $2,000 an ounce. The stock market has more than doubled, and real estate is in a state of euphoria. Crude oil prices are reaching $90 a barrel after hitting a negative $37 a barrel in March 2020. The CPI indicates that commodity prices are exploding. Federal Reserve Board Governor Lael Brainard on Monday laid out a strong case for the central bank to maintain low interest rates, saying that the spike seen in inflation this year was transitory and the labor market was far from being healed. September 27, 2021. According to Federal Reserve Chairman Powell, all of this inflationary pressure is transitory, but it feels more like a pressure cooker releasing all the pent-up inflation we have exported to the world since President Nixon took the dollar off the gold standard in 1971. U.S. debt has exploded to close to $30 trillion and counting, and the U.S. dollar has declined more than 98% against the U.S. dollar reserve currency. For commodities through 2020 was not all bad. In August, gold topped $2,000 an ounce for the first time ever, increasing by 16.8% in US dollar terms as low interest rates made the previous metal a more appealing haven than treasuries, even outperforming many prominent asset classes in the process. Gold can act as an insurance policy against monetary devaluation, especially if the dollar weakens. Dollar weakness has traditionally led to gold prices rising with a globally led devaluation of fiat currencies. More so than ever, we anticipate higher gold prices. Silver is another precious metal that has witnessed significant gains over the last year, touching the $30 an ounce mark in early August, a price point it hadn't achieved in more than 5 years. However, what makes silver an underrated investment opportunity is its place in various industrial applications, especially since a number of products and chemical processes make use of this metal. And such application is in solar panels, one with the Biden-Harris administration. We can anticipate a more aggressive approach to the reduction of fossil fuels. With its fundamentals, one wonders why gold is not at 50,000 an ounce, similar to Bitcoin's price. The world knows that gold is a centralized monetary asset. It is and will always be the other side of fiat currency. It has been proven asset. It has been a proven asset for thousands of years, especially when economies enter an inflationary or hyperinflationary cycle. The big difference between then and now is that we have Bitcoin, which was created by the demand for a decentralized asset that would offer the same protection as gold against imploding currencies like the US dollar. The advances in acceleration in technology today are unprecedented. We are transforming our physical world into a digital world. With blockchain technology as the foundation, the future promises exciting opportunities. Gold is about to explode. The gold market has been completely ignored the past 12 months. We have gone into a second corrective wave that is about to revert and begin the third leg of a long-term bull market that started in March 2020. The fact that gold is ignored may be one of the most bullish signs from a historic perspective. When gold unleashes its reversion to the mean, it will be a spectacular move, and most people will miss it. The collective sentiment on gold is the most bearish in the face of the most bullish fundamentals ever. The economics of price alone are a screaming buy signal when you compare it to other financial assets, digital or non-digital. I believe that gold and silver are setting up for a historic move during historic times, said Equity Management CEO Patrick MontesDeOca. Mean reversion trading. We use our proprietary AI algorithm, the Variable Changing Price Momentum Indicator VCPMI, to technically analyze the markets. According to the VCPMI and our robo-advisor, Nikki the Robot, the weekly trend momentum of 1781 is bullish. The weekly price momentum of 1790 is bullish. This is the velocity of price in relation to the bigger trend. Exit longs at the sell 1 and 2 levels of 1819 to 1845. Exit shorts at the buy 1 and 2 levels of 1764 and 1734. The VCPMI identifies the extreme levels above and below the mean when the market is most likely to revert back to the mean. Entering trades at the buy 1 and sell levels, the extreme levels away from the mean, offer the highest probability trades. There is a 90% probability from the sell and buy 1 levels and a 95% from the sell and buy 2 levels. That the market will revert from those levels back to the mean. Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, ema2trade.com, or listen to any of our previous episodes. Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room. I apologize for that delay here. We got some fast market conditions that has brought the gold market down to the buy one level of 1766. On the report earlier here, we pointed out that the average price, the weekly average price, was 1790. And what the market has done is it has come down below the daily level of support of 1797. It has come down, completed the target of the weekly mean average price of 1790, and it has come down to the buy two level of the daily level of support of 1786. So what we are seeing here is what the report was pretty much anticipating, in that this is the extreme below the mean. Now, the weekly average price of 1790 has activated 1764, which is the weekly target or trigger point for the weekly. What seems to be unfolding here is a bearish price momentum. Now, just to clarify, the VCPMI, the variable changing price momentum indicator, is the average price that identifies the average for the daily, the weekly, or the monthly patterns. And when the price trades above that average, it's bullish, and below it's bearish. But it is a price momentum in relation to the bigger trend. It's the velocity of price that, could reach these levels within the bigger trend. Now, to look at the daily chart, what you see here is that essentially the market made the low as anticipated on September 29, and we published this a few months back. Actually, we publish it every year. We forecast the 360-day cycle as of September 28, 2021. And we do that every year. We follow the September to September calendar year. And so this is the confirmation that we expected as the seasonal cycle unfolded, and it reverted back to the weekly mean, the weekly average price, and almost went up to the weekly and daily extreme levels above the mean. So let me take a look at the December excuse me. What we're looking at here is basically the market trading above the monthly average price of 1772, which activated a bullish price momentum for the monthly, and it almost got up to the target of the sell one level, which is 1823. And what we have seen here is the market revert from these levels from a lower high as basically is in the area between the monthly average and the annual average of 1840. So when we are in the area of green, or the average price, it basically is a very choppy area. And so we suggest, obviously, to take caution, to maintain a defensive approach, looking for more confirmation mathematically what the market wants to do. And obviously, below the average price, it's a bearish indication, but even here, you see the market coming down around March and into this level that has been identified as the area where the AI suggests that you want to accumulate supply, and that's in the 1707 area, 1700 area, as low as 1677, which was the capitulation of the market that we made back in August 9th with a low of 1677. And I just wanted to show you the indicators in terms of the AI translation of what the code basically tells the computer, the robot, to execute. And right now, it's basically on the monthly and the yearly, it's in a bearish yearly price momentum because the market is trading below 1840, but it is in a bullish monthly price momentum because it is trading above the monthly average of 1772. So we are going to be in a choppy area. As you can see, this gives us the clarification in terms of the price momentum in relation to its you might say, pricing levels, whether it is well priced or average priced. When it trades around the average, it's pretty balanced, you might say. So it seems that the average price here for gold is 1772 to 1740. Now, this identifies for us that essentially, if the price closes below 1772, it's going to activate a bearish price momentum, and we're looking at the lower numbers to be completed. On the monthly, you're looking at the 1707 to 1656, and on the annual, you're looking at 1572. All the way down to 1572, which is the first one, down to 1409 for the annual patterns that we're looking at. Now, the variable changing price momentum indicators gives us the extreme levels above the mean or the average and the extreme levels below the mean or the average, whether you day trade, swing trade, or position trade. And so in looking at the monthly and daily, we're getting a mixed picture. In order to clarify the view, then we go into the daily and the weekly numbers, because that is essentially when the market gives us a clear picture when the reversion is unfolding. Within that mixed monthly and yearly trend. One of the things that I want to clarify here for a minute in terms of the way that I take a look at the market and the way that I trade the market and the way that I am coaching my traders to take a look at is essentially the market is divided into segments, what I call, or what people call trends. And you can customize even the time frames that you're looking to analyze, from a 5 minute or even from a second, depending upon your analysis. And you can customize the trends, but based on conventional wisdom, we have the daily, weekly, and monthly, annual, and cyclical trends that we look at, as they do have a longer term pattern that we can identify in identifying those trends, and also consistency as we look at the highest probability trends in order for us to code the variable changing price momentum indicator. And so when we take a look at the daily information, it gives us a very specific structure. The VCPMI is a 5.5 pivot point Fibonacci structure. It expands the pivot points into a probability model that identifies the extreme levels of speculation above the market average price and below the market average price. And the methodology identifies for us mathematically the relationship of price within those specific trends. So let me be specific here. We're looking at the daily trend. On the left of the chart, the daily data that we got for today. And it's telling us that 1797 to 1786 are the extreme levels below the mean. So in relation to what the market is doing, the market is obviously has negated this bullish pattern that was activated earlier. It completed the pattern basically right away from the buy one level to the target, which is the level above, in this case, the mean. And automatically we experienced a lot of supplies that brought the market through the buy one, through the buy two levels of support. And so what you see here is the market has broken the daily. It also has broken the weekly average of 1790. Now, we use the 15-minute bar to identify for us the shorter time frame where we can execute the signals. And we use the 15-minute bar to execute the signal. So what you see here is that the daily has gone neutral. The buy two level of the daily signal has gone neutral. When the market closes below or trades below that level, the system becomes neutral. The signal becomes neutral. And then the weekly trends begin to overpower, you might say, that daily trend. And what we have here is the weekly average price of 1790, and with the market trading below that average price, it's beginning to build a bearish price momentum. As I said earlier, trading below the average price activates a bearish price momentum, and then you look at the level below as the target. And in this case, we're looking at 1764 has been activated. Now, we have a daily neutral signal that's been activated, and we're falling into a bearish price momentum now. The momentum is the velocity of price that for this week, it has a target of 1764. Now, the VCPMI, or the variable changing price momentum, that's why it's called the variable changing price momentum indicator, always gives you the alternate count. And if we take a look at the alternate count, then we begin to look at the daily of 1786. If the market gravitates above that daily price and closes above 1786, it's going to activate a buy trigger. Automatically, the targets are above. In this case, the short-term target would be the 90, which is the weekly average. And then if it trades above the weekly average, then it's picking up the momentum on the weekly now. And the 1797 is the next target. So we let the market dictate the momentum of price in relation to the bigger trend. And so we have a pretty clear picture defined in terms of what we need to do based on what the market does. And so the variable change in price momentum indicator is a prospective mathematical probability model that identifies the extreme levels above or below when the signals are activated. In this case, you're looking at a 1786.40 being activated. And we're going to be buying a gold at the market here. Long 1787, buy gold at the market, and automatically it gives you three choices of stops. The first one would be a close below 1786 using the 15-minute bar. You can use a maximum dollar stop, what I call a catastrophe stop, based on your profile, or you can use basically the close of the day. When you're trading from the extreme below the mean, depending upon your appetite for risk, it's a 95% probability that the market more than likely will tend to revert back up to the mean. And in this case, that would be the 1805 level. So I'm pretty comfortable with the position, and we're going to hold it here, let the market do its thing, and we have a pretty clear picture in terms of the frame that we have on the trade. Thank you, everybody, once again, for this great opportunity to share this information with you. And I look forward in seeing you next time. Please take care of yourself and have a great week. Talk to you soon.